So has AST SpaceMobile finally started turning its giant promise into an actual business? The company just published its second quarter update, and it happens to answer the three questions we left open last time: Japan, the launch pace after the failure, and the money. Quick note before we dig in, this is just my personal take, not financial advice, so please do your own research. If you're new here, the one-line refresher: AST SpaceMobile is building a cellular network in orbit that connects directly to normal, unmodified smartphones, and the company describes itself as the first and only one doing exactly that. Everyone else knows the story, so today is about what changed. 4 parts. Part 1, the constellation, what actually flies now. Part 2, the demand side, including the Japan decision we were waiting for. Part 3, the money, fresh revenue, confirmed guidance, and a new billion-dollar financing. Part 4, what has to go right, including the price tag that finally showed up for the failed launch. At the end, my direct answer to the opening question, plus where I could be wrong. Part 1, the constellation. As of this update, 13 spacecraft are in orbit, each one, per the company, the largest ever placed in low Earth orbit, with roughly 20,000 square feet of combined antenna surface deployed. The pace is the headline. 6 spacecraft went up within 50 days. The next 3 are, per the update, ready to ship shortly, and production now stretches all the way through satellite number 46 in various stages of assembly, deeper into the line than when we last covered it. On performance, the update reports nearly 100 megabits per second demonstrated on the current generation, with peak rates approaching 200 megabits expected from the next one, helped by a proprietary chip with up to 10 gigahertz of processing bandwidth per satellite that management says unlocks a roughly tenfold improvement in throughput. Underneath it sits Spectrum, the licensed radio frequencies every network needs. The company targets access to roughly 100 megahertz in the United States and more than 60 megahertz globally, blending frequencies shared with its carrier partners and satellite spectrum it controls itself. And the ground layer is catching up. Nearly 50 gateways, the stations linking satellites to the carrier's networks in various stages of completion, plus an initial 3,000 digital cells activated across the continental United States, with beta service for select partners planned for 2026. Per the update, that's the mini verdict for Part 1 already. This stopped being a concept a while ago, and it now reads like a construction site running on a schedule. Part 2, the demand side, and first the resolution from the last video's cliffhanger. Back then, Japan was an open race. Now the update says the joint venture of AST SpaceMobile and Rakuten has been preliminarily selected by the Japanese Communications Ministry for the National Space Connectivity Initiative, with an expected value of up to roughly $1 billion in non-dilutive, non-debt government capital, meaning money that creates no new shares and no borrowings. Preliminary is the operative word. This is a selection, and a selection is not yet a signed check. The bigger surprise sits in the United States. The update points to a new joint venture planned by the top 3 American carriers, expected to bring space-based cellular connectivity to every American. Phrasing straight from the release, which names no names, though longtime viewers know 2 of the big 3 have been on AST's partner list for years. Across Europe, network integration and testing is underway with Vodafone, Orange, Telefonica, Vodafone Ukraine, and Deutsche Telekom, plus work in Canada, Japan, and Saudi Arabia, all of it, in the company's own words, subject to final regulatory approvals. The wider frame: more than 60 mobile network operator partnerships whose networks together cover over 3 billion subscribers, and precision on that number. It describes the partners' combined customer bases, potential reach, and no one has promised those people become paying users. Add the government layer, from the FirstNet public safety network in the United States to emergency band work in Japan and Ireland, plus American national security awards totaling more than $125 million, and the contracted revenue backlog climbs to roughly $1.3 billion, up from last time, with contracted, as always, never meaning collected. Founder and chief executive Abel Avalon calls this the space-based cellular broadband market we invented. And sure, he founded the place founders talk like that, but the partner list underneath the sentence is what keeps it from being just a slogan. Mini verdict, part 2. The demand side widened on 3 continents in a single quarter, and it still hedges itself openly with approvals pending. Part 3, the money and 2 things in this report will look rough on a first read, so let me explain them instead of defending them. The revenue line here and the loss weighting in part 4. Revenue came in at $31.5 million for the quarter, against barely $1 million in the same quarter last year, and roughly double the first quarter of this year, driven by gateway equipment deliveries and milestones met on American government contracts. Notice what that revenue is and what it is not yet. Hardware and program money, lumpy by nature because equipment ships and milestones close on their own calendar, and the consumer service itself has not started, which is exactly why the beta matters so much. For the full year, management confirms guidance of $150 to $200 million and states the condition openly, supported by additional contract awards from the government. Quick back of the envelope, labeled as such, the first half brought roughly $46 million, so the guidance implies a second half more than twice the size of the first, up to roughly triple at the top end, with the release itself tying that ramp to awards still landing. Now, the war chest, cash equivalents, and restricted cash of about $2.7 billion at the end of June. In July, the company raised another $1.15 billion gross through convertible senior notes, bonds that can later turn into shares, with a coupon of 1.625%, an effective conversion price the company puts at $149.20 per share, and in the company's own framing, effective dilution of less than 2%. Here's why those terms matter. The low coupon keeps the interest bill small while the build-out runs, and the conversion parameters decide how much existing shareholders eventually share with note holders. Pro forma, the update reports over $3.7 billion available. Against that stands the spending. In the first half alone, roughly $860 million went into property and equipment, plus around $140 million more for spectrum rights and capital advances to a spectrum partner. Call it $1 billion of build-out in 6 months, my rounding, while long-term debt now sits near $3 billion. Mini verdict, part 3, the funding is real, the burn is just as real, and the race between the two is the actual business model right now. And part 4, what has to go right, and the quarter delivers the first exhibit itself. Total operating expenses jumped to roughly $329 million. And the single biggest reason is a loss on involuntary conversion of about $126 million. Involuntary conversion is accounting language for an asset you lost rather than sold, with insurance stepping in, and the cash flow statement ties the insurance proceeds, about $22 million received in the period, to the launch of the 7th Bluebird, the satellite lost in the failure we covered in the summer. So the event we covered back then now has a price tag on the books. And the lesson stands: putting the largest spacecraft ever built into orbit carries real bookable risk, and insurance replaces money, not months. And the gap matters. Over $100 million of that booked loss stood unreplaced as of this update, and whether more follows, the filing doesn't say. Strip out that loss, depreciation and stock compensation, and adjusted operating expenses still climbed from about $91 million in the first quarter to roughly $119 million, the plain cost of scaling. The bottom line, a net loss attributable to shareholders of about $231 million, wider than the first quarter's figure. And there's the dilution ledger. The weighted share count grew from roughly 242 million a year ago to about 299 million. Stock compensation runs heavy, and the new notes can add shares later within the limits the company describes. Layer on the softer risks in the company's own words: approvals still pending across key markets, a Japanese selection that is preliminary, guidance leaning on additional awards, and competitors its own risk section names as a factor. Mini verdict: Part 4. Nothing here breaks the thesis, and everything here prices it. This is a company spending billions to reach a market. It still has to switch on. So the opening question, has the promise started turning into a business? My answer, and the reason I stay bullish here, yes, visibly for the first time, and precisely because the boring numbers moved. Revenue roughly doubling quarter over quarter, a backlog above $1 billion, a launch line running 6 spacecraft in 50 days, Japan resolved in AST's favor at the preliminary stage, and a funding position the company calls fortified. The promise part has not disappeared. The consumer service that justifies the whole long-term story is still ahead of us, but the distance between promise and product shrank on nearly every page of this update. What would prove me wrong is easy. Launches failing again, and this quarter shows what one failure costs. Approvals slipping, the second half ramp leaning on awards that then don't land, or a beta that stays quiet. If the coming quarters avoid those traps, this update becomes the boring middle chapter of a much bigger story, and boring middle chapters are exactly what infrastructure investors want. Now, the full disclaimer, this is not a recommendation to buy or sell anything. I'm not a financial advisor. Nothing in this video is personal investment advice, and please do your own research, especially with a company this early. I could be wrong about all of this. In timing and direction, space has humbled far better forecasters than me. Which stock should I break down next? Tell me in the comments. That's where I pick what comes next.